For investors new to the fund, what does GCP Infrastructure Investments actually invest in, and what role can it play in a portfolio?
GCP Infrastructure invests in UK-based infrastructure assets, so we're funding the private companies that build, own, operate infrastructure assets with a focus on UK infrastructure, so all of the portfolio is based in the UK. The fund focuses on infrastructure that benefits from some form of public sector-backed revenue stream. So historically, the universe of investments has been those sectors that the UK government is seeking to support through long-dated revenue models such as PFI, PPP or renewable subsidies or supported social housing. In investment, we focus on debt rather than equity as part of the capital structure. So we're focused on lending to those infrastructure projects where the repayment of the debt is underpinned by the cash flows generated by infrastructure assets over their lives.
Your portfolio spans 47 investments across infrastructure sectors. How does that diversification help deliver resilient returns?
I think diversification is one of the key competitive strengths of GCP when compared with other infrastructure or renewables funds that focus on a single asset class. The fact historically that we've had an explicit objective of diversifying has meant we've adapted to new interest in support models, or when we've seen sectors mature in infrastructure. If we go back to 2010 and imagine how we thought about solar, a lot of questions we had from investors were, what do you mean there's sun in the UK? How is this going to connect to the grid? How are we going to manage the subsidies? What if it's not built in time? Who's going to operate and maintain them? All risks that have changed because of the deployment over time and as that asset class has become better understood in the UK. That means discount rates come down, the sector becomes more competitive, so the returns available change. GCP's response to that hasn't been to have to continue to invest in that asset class and increase leverage or perhaps go to other geographies. It's been to diversify into new areas and find new attractive asset classes that have a better risk-adjusted return. So I think what that gives investors today is diversification in asset class. So whilst the wind might be shining, wind might be blowing and the sun's shining, you have a diversified exposure in terms of what drives assets and what delivers revenues for those assets. Increasing in the UK, there's been a lot of change to infrastructure asset classes. Increasingly, we're seeing wind and solar cannibalise their own prices. So the fact that we have both baseload assets and intermittent generation in our portfolio diversifies investors' exposure to different subsidy regimes. I think the risk of changes to the subsidy regimes is also, I think, lower because we are exposed to multiple different asset classes. We saw at the start of this year the government changed the indexation applied to the renewables obligation and feed-in tariff. That did have an impact on the company, but it was well diversified across a range of different asset classes, which meant that impact wasn't as high as perhaps it otherwise would have been. So diversification, I guess, as always, is I think, a really effective mitigant of asset-specific risks that fundamentally all infrastructure asset classes are exposed to.
Much of the portfolio benefits from inflation-linked revenues. How valuable is that in today's economic environment?
I think inflation linkage is one of infrastructure's key attractive features. I think the fact that infrastructure assets are real physical assets that benefit from long-dated cash flows means that as part of those cash flows, there has to be some recognition that things change over time, whether that's operating costs or financing costs that an asset might be subject to. Therefore, having a natural hedge in the revenue models for changes to inflation is a sensible thing to do. What that means in a higher rate environment is that there's a natural hedge in terms of the cash flows generated by the underlying projects. Over the last few years, we've seen higher inflation result in higher uplifts to revenues on an annual basis, which perhaps compensates for a higher rate environment and a higher risk-free rate against which ultimately the returns of infrastructure are compared to. So we often compare the portfolio with inflation or index-linked gilts as a sort of benchmark proxy, given that's what the underlying revenue makeup effectively is.
The portfolio currently delivers an 8% annualized yield. How do you balance generating income and protecting shareholder capital?
So both income and capital preservation are two of the core objectives of the fund, alongside diversification, which we touched on earlier. Income, I think, fundamentally is a characteristic of infrastructure. High upfront capital costs that need to be repaid over the life of the asset mean that naturally infrastructure is an effective deliverer of income. It is long-dated, relatively fixed income with some inflation protection which acts as a natural hedge, but it is a long-dated income instrument, which makes it subject to changes in the wider rate environment, and that you do have to take a long-term approach to investing in infrastructure. So income is a natural feature of infrastructure assets. Capital preservation, I think, is equally as important to us. I think there's two aspects to that. The first, infrastructure by its nature is a defensive asset class. It benefits from real physical assets delivering a service to society over a long time frame. That means investors have the benefit of the intrinsic value of that asset and the services it provides. It's really hard to build new infrastructure, particularly in countries like the UK. So actually the barriers to entry mean that competition or substitution of that service or good that an infrastructure asset provides is a low risk. So the monopolistic nature of infrastructure in many cases is a benefit and gives downside protection. I think for GCP specifically, the fact that we focus on debt rather than equity means we're very focused in an investment process on how we get paid back. I think in a debt fund, you make money by not losing money, so how we ultimately get capital return through the cash flows generated by an asset over its life is a key part of our investment process. And I think that provides an additional layer of downside protection. Debt is fundamentally paid back before equity, and equity are taken a first loss position in the assets in which we invest.
The NAV has remained remarkably stable despite changing market conditions. What's been driving that resilience?
So I think it's infrastructure doing what we say it should have done. I think the fact is infrastructure is defensive, it's non-correlated, and therefore shouldn't be exposed to what's happening in the wider macro environment. And actually, if you look back since the 15 years since IPO, there's been quite a lot that's happened. If we go back to nationalisation's concerns around PFI, COVID, geopolitical uncertainty, energy shocks, there's been quite a lot going on that should have impacted asset valuations, but in terms of infrastructure, hasn't. I think that's particularly true for GCP. The nature of the assets we invest in have availability-based cash flows, so assets are paid based on whether or not they're available to be used, not how much they're used or if they're used. And I guess that's more demand-based economic infrastructure, such as ports or toll roads, that might be more exposed to economic growth or have more linkage to, say, GDP or economic performance. So a focus on availability-based assets has really helped GCP in terms of that defensive, non-correlated nature of ultimately the projects in which we invest. I think the fact that, again, we focus on debt rather than equity means we are less exposed to those day-to-day changes in revenues or valuations of projects. We have the equity buffer that insulates us from those changes.
Electricity price forecast continues to move around. How exposed is the portfolio to power prices, and how do you manage that risk?
You're absolutely right, electricity prices remain volatile, and I think increasingly are more volatile as the electricity system is made up of more intermittency. And I think as we expect demand to increase over the coming decade or so, driven by electrification of heat, transport, but also the digitalisation and demand from data centres and AI. GCP is exposed. We invest in electricity generation projects such as wind farms or solar projects or waste power stations. So therefore the revenues that those projects benefit from is a function of power price. We do try to hedge that in the short term by locking in fixed prices for the front 1, 2 or 3 years at the underlying asset level that fixes revenues over that time frame. But those assets are still exposed to long-dated views of where power prices will ultimately evolve. I think the other point we've often made on this in our disclosures is there is quite a wide difference between where long-term or consultants forecast the long-term power price. GCP uses the more conservative or the lower of 3 market forecasters to predict long-term power prices. I think there's less risk or a more conservative valuation bias in our portfolio than perhaps investors will find elsewhere. I think it's important to also recognise these are long-term investments and long-term assets, so short-term changes to power price expectations do even out over the longer time frame. We've seen some very high periods of power prices going back to 2021, 2022. We're still in elevated periods of power prices given the geopolitical certainty in the Middle East flowing through into gas prices and ultimately into power prices here in the UK. That all could change and it does remain volatile. I think the other aspect of power prices we're increasingly seeing is divergence between what a baseload generator, so a generator that's operating 24/7, benefits from versus, say, a wind farm that's only getting paid when the wind's blowing. And when the wind's blowing, all of the wind's blowing, which means there's lots of low marginal cost generation put onto the grid. So effectively wind and solar are cannibalising themselves because as deployment has grown over time. So the other dynamic I think we've seen over the last 10 years or so is an increasing divergence between base load prices and the capture price, as we call it, for wind and solar projects, which is part of a diversified portfolio. Again, I think is mitigated in GCP's portfolio across our various assets.
The portfolio has an average life of around 11 years. What advantages does that long-term approach give investors?
I think it's for investors that have a long-term approach to investing. I think what I've often described GCP as a bit of a supertanker. We have a portfolio of 47 investments, weighted average life of 11 years. Portfolio generates on average 8%. To change that overnight is actually quite hard. Over time, the portfolio will evolve as loans repay or we sell out of assets, as we have been doing recently, and come into new assets. But it's hard to change that overnight. So I think that with that, I guess, comes a resilience in terms of the income and cash flows being generated by the portfolio. There's a natural momentum and weight there that also doesn't change overnight. Yes, there's short-term issues with specific assets, but overall, if we take the life of the assets in context, it's a resilient, stable portfolio. So I think investors benefit from that. I think it would be right to acknowledge it is a relatively long duration fixed rate instrument, notwithstanding the inflation protection that we discussed. So I think investors have to be conscious of, in a higher rate environment, there will be an impact on the relative attractiveness of GCP's cash flows. And I think we've seen that recently with the nature of the share price moving to a discount to net asset value, in part, I think, driven by the effect of being in a higher central bank rate environment.
Looking across the portfolio today, which sectors are giving you the greatest confidence?
So I think all of the portfolio is performing well. I think PFI remains a hugely stable, resilient part of the portfolio, and actually GCP's portfolio is underpinned by relatively small healthcare, leisure, education assets that are as critical today in providing services within the communities in which they operate as they ever have been. We are watching closely what happens as those projects reach the end of their life and are handed back to the local authorities, and whether in some cases there's the opportunity to extend those arrangements and continue to house those assets in a private context. I think there's huge opportunities in the decarbonisation thematic. Infrastructure has a huge role to play if we look at some of society's biggest challenges: decarbonisation, digitalisation, the growing and ageing populations, so changes to our demographic. The government have mooted the reintroduction of the PFI PPP model. We think that will be focused on healthcare in the first instance. We need to invest a huge amount in defence, and that's certainly a focus. And for the first time, I think the National Infrastructure Committee published their infrastructure review that had defence as part of an infrastructure spend, which I thought was an interesting development that's probably happened and evolved over time. So But I think in terms of GCP, where we are focused on what long-dated support models exist today, it very much is focused in decarbonisation, both in core asset classes that we know well. More solar, wind, offshore wind has been a real success story in terms of deployment in the UK, but also other things. And I think the government have actually been quite creative, the previous government and this government, in introducing contract for difference models for the carbon business model, for dispatchable power, for hydrogen, for sustainable aviation fuel, that expands the available support mechanisms to some interesting areas, and GCP is really well placed to benefit from that should those sectors develop over time.
You've recently completed the sale of 2 onshore wind farms at a 13% premium to book value. What does that transaction tell us about the value embedded in the portfolio?
So I think that specific transaction shows the market valued those assets higher than we were holding them on our book, and I think that goes to perhaps my comments earlier on how we approach asset valuations. And I think we come in from a debt perspective, have been more conservative than the wider peer group and market more broadly, perhaps in what power curve we use, what asset life assumptions we use. I think the other dynamic is where I think we haven't recognised value where perhaps others see it, is what happens at the end of an asset life. This country has embarked on a pretty aggressive decarbonisation plan, decarbonising our electricity grid by 2035, net zero by 2050. And I know there's some political noise around that, but I think fundamentally the direction of travel won't fundamentally change. what that I think that points to is we're not going to be switching off everything we've built over the last 15 years only to have to rebuild it again. It makes eminent sense to extend the lives of assets, repower existing assets and use existing infrastructure, whether that's grid connections or otherwise. So I think there are investors increasingly that are targeting older assets that are reaching the end of their life, and whether it's a life extension or repowering strategy that they're placing on those assets. And that's not something we really value in terms of the assets that we hold. We're very much seen infrastructure investment as you invest in an asset over its original life, and you have to be fully repaid and generate your return over that life. There's no real residual value or end of life value that we've recognised, but I absolutely believe, and the transactional evidence points to that is there in reality, and it makes eminent sense that it is.
You've also announced significant repayments from supported housing and solar investments. Why is now the right time to recycle capital?
We've embarked on a capital allocation programme since the end of 2023, and really that was in response to where the share price was trading relative to the net asset value per share. The fund moved, as I think the sector more broadly did, across alternative income, REITs, infrastructure, renewables, to a discount to NAV. What that practically means is we're comparing the opportunity to buy back our own shares, so invest effectively in the company's own risk, versus make new investments in the market. One makes the company smaller, and we have to be conscious of that. Many of our shareholders would like us to retain some level of scale as a company, but at a certain discount, that's a compelling argument. So what we've been doing is proactively recycling the portfolio, exiting certain sectors to generate capital to, in the first instance, pay down the fund's leverage. When we started the programme, fund debt was at 104 million. Now, where we are today, there's no fund level debt, so we've completely repaid debt, and we've completed around £74 million worth of buybacks to date at the end of June. It's hard to say how that's impacted the discount. I think my approach and my interpretation of it is that has been the best use of the company's capital, and the more we can do that, the more ultimately it's accretive to dividend coverage if we can buy back shares at a discount, as well as being accretive to NAV. So I think it's a sensible thing to do, and that's why we've been doing it. We've also been quite intentional about those sectors that we're trading out of, and we've been quite disciplined about targeting a reduced equity-like exposure in the portfolio, so reducing exposure to elements like power price risk, but also exiting supported social housing as a sector, which I think is one of the lower returning sectors that we invest in, also has quite a long duration, so pulls out our duration from that 11 years today. If we sold out of that sector, it would come into about 8 years, so less interest rate risk perhaps in the fund were we to exit that. And I'm pleased to say that the transactions that we've done so far, we've completed or exchanged on around £180 million worth of transactions. On average, that's been at or above NAV, so it's demonstrated that NAV is an appropriate valuation point, certainly more so than share price would otherwise imply at a discount. We've paid down debt and we've returned capital to shareholders and have transacted in those target sectors that we sought to reweight the portfolio out of.
Once proceeds are received, how do you decide between paying down debt, making new investments, and buying back shares? Yeah,
so we've paid down debt. That was always going to be our first priority in the kind of waterfall of uses of cash. I think the decision between investing and buying back shares is more nuanced, and I think that really is a function of the discount at which the share price is trading. The guidance we've given the market, and we set out this framework at our Capital Markets Day early this year, was at a discount of 15% or more, we'll be buying back shares. And that's because we think at that level, the most compelling use of our capital is to invest effectively in our own risk. And I think that any discount less than 15%, we have the opportunity to weigh up new compelling investment opportunities with a continued repurchase of the company's shares. The company today is about a 16% discount, so we have been buying back shares so far. We're not far away from the place where we might be considering new investments. Practically, we haven't made any new investments for the last 3 years, just given the nature of the relationship between net asset value and market cap.
Do these disposals help demonstrate that the market may be undervaluing the portfolio?
Yeah, I mean, yes, I think they do. I think where we've sold assets at NAV and the share price is implying the asset should be valued elsewhere, there's a difference there. I think we've spent quite a lot of time trying to understand what's driving share price. I think there's certainly an aspect of being in a higher rate environment, on a relative basis, a long-dated infrastructure cash flow does look less attractive. So I think there's a rate effect there. Typically, the fund traded at a premium for most of its life, but that was when we were in a very low rate environment. So rates have gone up. Naturally, I think it would be fair to assume the share prices re-rate off the back of that. I think the other dynamic we've seen, and I think this has probably had a bigger impact, is reallocation of investors' capital away from alternative income, perhaps in favour of more traditional sources of fixed income, bonds, gilts, money market funds, who have been huge beneficiaries of inflows over the last 3 or 4 years. And what that's meant is this lack of demand for alternative income products like GCP infrastructure. I think we're starting to see that perhaps change, a focus on hard assets, limited obsolescence, so moving away from perhaps software risks or obsolescence risks with AI to hard assets generated a long-term income. I think we've seen that as a theme where perhaps people are coming back into infrastructure. And I guess as central bank rates come down, perhaps infrastructure becomes more attractive from an income perspective as well.
Infrastructure investment continues to benefit from long-term themes such as energy security and the transition to net zero. Where are you seeing the most attractive opportunities today?
So I think definitely decarbonisation is an area we're seeing lots of opportunities still, whether that's secondary or primary investment, so building new assets or buying existing assets. I think you're absolutely right that energy security has come more to the fore perhaps than decarbonisation, and I think there's also an increased focus on price and cost of energy. So onshoring supply chains or effectively building resilience in our energy system within nation states has definitely become more of a focus. Infrastructure again has a key role to play, and I don't necessarily think security of supply and decarbonisation are at odds with each other in that respect. I think low cost renewable generation is a way to address security of supply challenges. So definitely those areas, and as I touched on earlier, I think the fact that the government have introduced new support mechanisms for how we decarbonise heat, how we decarbonise transport, how we decarbonise our industrial sector through the hydrogen business model, the carbon business model, our aviation sector, there's a lot more we need to do than just decarbonise how we generate electricity, which is where a lot of the capital investment and focus has been historically. So they're interesting and exciting new areas, and GCP has got a long track record of getting into sectors early and investing before sectors become mainstream. We're watching quite closely what happens with the new PFI PPP model in the UK. We think something will be introduced in healthcare, potentially in defence in due course as well. There's been some really interesting models in the water sector, a sector that's been quite underinvested in the UK over the last few decades. The direct procurement for customers model is a PFI PPP equivalent for the water sector. We saw the first project complete under that last year. The Hawes Water Aqueduct Resilience Scheme, or HARP, was a really interesting project that I'd encourage people to look up, but a really good example of a huge infrastructure project delivered under a new mechanism that the government have introduced. OFTO, so the offshore transmission networks, and the onshore equivalent CATOs are also areas Gravis is closely watching and involved in the Tender Round 13 process for the current OFTO bid. That's a long-dated 25-year CPI-linked regulated asset-based type model, which we think is really attractive for GCP.
Interest rates have become more supportive for infrastructure assets. How does the current market environment affects both valuations and new investment opportunities?
So it's certainly true that risk-free rates have increased. I think the 10-year gilt today topped 5%, and I think that forms a base of evaluation of what's a premium over that investors will require for taking an infrastructure-like risk. So I think there has been a reset over the last 4 or 5 years of the required unlevered returns. The cost of debt has gone up, and therefore the cost of equity has gone up as well. I think it took some time to make that adjustment, and transactions weren't really happening. So I think we're sort of through that now, and I think we're seeing more liquidity in terms of secondary transactions and more interest perhaps in primary deals as well. The market has adjusted to that new cost. But it certainly does have an impact, and infrastructure is a really upfront capital intensive sector that capital needs to be funded, so actually any changes to the cost of capital does have a really significant impact on ultimately the cost of the service that an infrastructure project is delivering, which is ultimately a cost for you and I as consumers and users of that infrastructure. So it is hugely sensitive. We are, I think, still in an elevated rate environment, and that coming down would have a really material impact on particularly new build infrastructure projects and the cost of that infrastructure.
Looking ahead, should investors expect more portfolio disposals as part of your capital allocation strategy, or is the focus shifting back towards investments?
So we've said publicly that we want to continue to dispose of assets and turn over the portfolio. I think investors can expect more announcements on that in the coming months. Whilst we're at a discount, I think it makes sense to continue to execute on those target portfolio rebalances, so exit supported social housing, come out of more equity-like exposures within the renewable sectors to reduce electricity price exposure. So that remains an absolute focus, and I think investors can expect more on that. I think then what we do with that capital is probably more of the question where there's options, and buying back our shares at a 15% or greater discount is what we'll do. To the extent the discount narrows and it makes sense to consider compelling new investments, we'll absolutely be doing that, and maintaining scale is important to a large proportion of the shareholder base.
Finally, if we're having this conversation in a year's time, what would you hope that has changed that would demonstrate that the fund is delivering on its strategy?
So I think continued disposals at or above NAV would support the underlying valuation of assets, but also do what we've said we're going to do in terms of rebalancing the portfolio, particularly in the target sectors that we've set out. I'd like to think we go back to investment mode soon. Ultimately, I think there are some exciting opportunities out there. In a period of perhaps higher elevated rates, that's a good time to be locking in long-dated fixed rate on debt instruments. The fund did very well off the back of that. If we go back to IPO, when I think the 15-year gilt was at 475 and then came down to much lower than that. So I think there will be investment opportunities over the next 12 months that I'd like to think would be in a position to take, but ultimately that's a function of market price. I think the other thing investors we've been very focused on is disclosure. We launched an investor portal earlier this year that's had some really excellent feedback. Investors who want access should get in touch with Gravis, and we'll provide login details, but we think it's a market leading tool that gives investors really granular detail on what we've invested in. And disclosure has been a focus of mine as a lead manager over the last 7 or 8 years. So I think we'll continue to develop that and hopefully continue to give investors more insight into the ultimate risk of the projects in which they're invested in.